Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another Lessons in Valuation subscriber request series 2-minute drill video. These are short videos that I'm not featuring, but I'm being asked by subscribers to review. And Costco is one that I've been asked for several times. So let's look at the FastGraphs on Costco. And the first thing I want to say is, this is a quintessential example of the kind of company I like. It had almost a perfect earnings record. 1 year of down earnings during the Great Recession, but only minimally down. As you can see, you can barely see that the orange line ticked out a little bit. Otherwise, you have this perfect progression of growth. And growth has averaged 11.25%. Now, an 11% grower would technically require or indicate a 15 PE ratio for fair value, which would be a 6.67% yield. But this is a AA rated company with less than 24% debt. So the market has, almost understandably, normally put a premium valuation on the stock. Now I'm going to add the dividend line here because this is something I want you all to see. The dividend line is the white line on the graph, and you can see the company has a history of paying special dividends. They paid essentially, it looks like a $7 special dividend here. It looks like they paid about a $10 special dividend here. It looks like they paid about a $15 special dividend here. Otherwise, their dividends were in the $2 range, but you can see the special dividend there, the special dividend there, and so on. That's what these peaks are. But it's had a real good dividend record and an excellent earnings record. And this just is the dividend stacked on top of the orange line. Okay, but now what about valuation? Now, if I put the normal market PE ratio on the graph, you get, this is an average value that the stock has traded at. You can see that it's much higher, over 28 times earnings. Now, your perspective increases when you put price on the graph, and you can see that the price traded at or below the 28 times earnings until we got really into 2019, coming into COVID. And then we've had this huge drive up in price, in value. And right now the company has an earnings yield of less than 2%. That means if they paid you 100% of the profit because you owned 100% of the company, your return would only be 2%. All right, so that just indicates how overvalued. But we've added a feature to FastGraphs called the current valuation line, which you can access right here. So if I put the current valuation line, it draws a line at the current PE that currently is trading at 52 times earnings. Over 50 years in advance of current earnings, you're paying to buy the stock. And if you look at this, other than this little period right here that we've seen since like July of 24 to now, even the great Costco has never traded at such a high valuation. And this is after the market's been correcting so much. So my point is, this is a great company, unquestionably, probably one of my favorite companies in the world. But I need to buy it at least in 15 to 20 times earnings. I'm never going to pay 50 times earnings for it, no matter how much I like it. If this stock were to come to the senses and trade even at a very high normal PE, you could lose 38% of your money. And if it was to actually fall to where I think fair value was, you could lose 64% of your money. The forecasts are for only 9% earnings growth going forward, which is lower than historical. I think this is a great company. They've got a great analyst scorecard, so these estimates might be right, but the stock is clearly overvalued no matter how you measure it. Thanks for watching. It's Chuck Carnevale. I hope you enjoyed this video on Costco. If you did, give me a like, ring the bell so you can get more videos like this. And take a look at subscribing to the channel, but also take a look at subscribing to FastGraphs. Thanks for watching.